In this video, we start actually building the engines of the financial model as per the framework we covered in the previous couple of videos. The reason why we build the engines first, rather than schedules first, is because engines are more standardized compared to schedules. No matter how big or small the company is, which industry it belongs to, the engines of the financial model are mostly the same. On the other hand, schedules depend heavily on the characteristics of individual companies. For example, airline company and mining company should have completely different structure of revenue calculation schedule. So it is a good start to start learning engines first. Once we cover the engines, we can start building company-specific schedules one by one. Without further ado, let's see how each of the engines are built in the spreadsheet. As per the framework, we create dedicated tabs for schedules, engines, and financial statements. First, change the name of a tab containing financial statements to financial statements. Then copy the tab and name as schedule. This tab will be dedicated for schedules. By copying the tab, the same format can be utilized. Delete the whole data and copy it again and name it engine. Likewise, this tab will be dedicated for engines. The first engine is pre-tax cash flow. It receives revenue, OPEX, working capital, and capital expenditure numbers from the respective schedules. Then it feeds such information to other engines except income tax calculation. It starts with revenues. Separate rows can be made of different products, different customers, different markets, or different contracts, as the case may be. Then we list the OPEX. We can copy and paste the revenue section and replace revenue with OPEX for faster creation. We just list them by numbers, but they contain production costs, sales and general admin costs, rents, and etc. We add two more rows to capture other items that have impacts on EBITDA. They are not necessary, but sometimes used to explicitly input unidentified or hypothetical items into EBITDA. Add all items to calculate EBITDA. Finally, CapEx and cash flow to fund working capital movements follow, and this completes pre-tax cash flow engine. Next, we create income calculation engine. Copy and paste the title of pre-tax cash flow. Then we can override income tax calculation, maintaining the format. It starts from EBITDA. EBITDA is taken from the previous pre-tax cash flow engine. Depreciation and amortization follow. EBITDA is before depreciation and amortization, so if we add depreciation and amortization, then it is no longer before depreciation and amortization. So we get EBIT. D and A are gone. Similarly, we add interest income and interest expense. Now, I is gone and we get earning before tax, or EBT. Finally, we include income taxes. It consists of income tax current and income tax deferred. Finally, it is E, or earning before nothing. This is the same as net income. We link the EBITDA from pre-tax cash flow engine. Depreciation, amortization, interest income and expense will be linked to their respective schedules. Income taxes will be linked to income tax calculation engine. We will later work on the formulas as we build the engines. Next, our third engine is income tax calculation. This engine is responsible for calculating taxable income, income tax expenses and deferred tax assets and liabilities. We hypothetically set 20% income tax rate throughout the period. Color blue indicates it is hard-coded number. Later in the process this will be one of the input variables, and will be linked to the input sheet. But for now, we keep them as hard-coded number. The first item is earning before tax. Income before tax as per accounting and taxable income as per tax regulation are two different things. For example, certain expenses are lost in the income statement, but may not be tax deductible for the government tax calculation purpose. This difference may be permanent, or temporary. If the difference is permanent, then the same amounts have to be adjusted to EBT. Earning before tax, adjusted for the permanent difference, is the basis for calculating income taxes per accounting. If the difference is temporary, then it is just a matter of timing. Impairment of fixed assets, amortization, depreciation are a few examples of the items causing temporary difference. After making such adjustments to income, we get taxable income for tax purposes. Income tax is calculated by taking earning before tax adjusted for the permanent difference, times the tax rate. Of the income tax, tax payable this year, or income tax current, is calculated as taxable income times the income tax rate. The difference between the two is income tax deferred. Income tax deferred causes either deferred tax asset or deferred tax liability to increase or decrease. We skip the calculation of deferred tax asset or liability for now, as interperiod tax allocation is a big topic itself. We will come back to it with specific examples. Next, we build cash flow waterfall. Cash flow waterfall takes care of how the free cash flow is distributed among the lenders and the shareholders. Cash flow waterfall within the financial model has to be structured precisely to reflect the legal reality about who can claim the company's free cash flow in what order. At the end of the day, one of the major purposes of building the financial model in the first place, is to analyze and assess which security, whether junior or senior, bears how much risk of default, and what is the IRR, or the return, to compensate for taking such risk. By definition, senior lenders have higher priority of claim on the company's free cash flow than junior, or subordinate lenders. After servicing the senior debt, junior debt can claim its share of interest payment and the principal repayment. Then, and only then equity holders claim their return. Within equity, preferred stockholder is regarded as senior equity than common stockholder. Note that the ordinary cash flow statement for financial reporting does not consider seniority, or the priority of the claim on the company's cash flow. As we will soon see in the spreadsheet, the first step of building the cash flow waterfall is to calculate the free cash flow. Free cash flow is calculated by NOPAT plus, working capital adjustment plus CapEx, plus add back depreciation and amortization. NOPAT is net operating profit after tax, aka unlevered net income. Unlevered means simply assuming there is no debt. So we take EBIT, plus tax on EBIT. EBIT eliminates interest income and expense, hence eliminating the effect of debt financing. We assume no debt financing when calculating NOPAT, because free cash flow is, by definition, available cash flow before debt service and distributing return to equity holders. After calculating free cash flow, then add debt drawdown, debt repayment, interest payment. If we have multiple debts with different seniority, then make sure the loan drawdown, interest payment, principal repayment are all placed in the order of priorities as per the loan agreements in place. After servicing debt, the remaining cash flow is available for equity. Distribution can be done through dividend payment, share repurchase, or outright return of capital. If the cash flow after distribution is negative, then revolver is drawn down to fill the negative cash flow. Revolver is like an overdraft. The company can borrow without specific repayment due date, up to a certain limit. On the other hand, if cash flow is positive after distribution to equity, then it will either increase the cash balance, or repays the revolver debt facility. The combination of cash account and the revolver facility work as a plug in the financial model, and plays an essential role, as the plug ensures that debit and credit side of the balance sheet are equal. This spreadsheet structure illustrates merely one example of cash flow waterfall. Unlike other engines, cash flow waterfall may be structured differently depending on the actual financing structure the company has in place. For example, letter of credit provided by banks has to be included in this engine if the company has such credit line. Or, you may be modeling a project finance with multiple levels of senior and junior debt facilities. Some loan facilities may have covenants, or restriction of cash distribution to equity. Such covenants may restrict the distributions to equity within certain limit, usually defined by DSCR, or debt service coverage ratio. Again, Financial Modeler is expected to structure the cash flow waterfall engine to reflect the reality of the actual finance conditions. This might be the most difficult engine to understand if you are not familiar with the financial model. But once used to it, you will soon realize it is just a distribution of the free cash flow that the company has earned among the capital providers of the company. Capital is funded by debt investors and equity investors. As per agreement, therefore as per the law, debt investor is entitled to claim their fair share of payment first. Before moving to the last engine, BS Corkscrew, let's link the formulas within the engines. There are many links between the engines, so we cover them one by one. The first formula is EBITDA from pre-tax cash flow to income calculation. Let's put the number of the formula to increase the visibility for later reference. Next, working capital movements and CapEx from pre-tax cash flow to cash flow waterfall. They are formula number 2 and 3. Since we skip the BS Corkscrew for now, we move on to income calculation engine. The next item is depreciation and amortization from income calculation to cash flow waterfall. Because they're next to each other, the formula can be said in one action. Then EBIT is provided to cash flow waterfall. EBT to income tax calculation. Then, income tax current and deferred from income tax calculation, back to income calculation. Again, you can link them in one go. Now, we have all of the formulas within the engines, except for linking to and from BS cash flow. BS Corkscrew calculates the beginning balance, increase, decrease, and the ending balance of all of the BS accounts. As for now, we only create cash balance, retained earnings, and add other BS accounts as they become necessary when modeling the actual transaction such as revenue, OPEX, etc. Beginning balance of the year equal the ending balance of the previous year. BB of the very first year, in this case, year 2020, has to be taken from the opening balance sheet. For now we maintain the formula and link it to the column F. We deal with the opening balance sheet later. Cash increase is derived from cash flow waterfalls cash increase. Cash decrease corresponds with cash flow waterfalls filled by cash balance. Same format for retained earnings. We can copy and paste cash, and change the name and formula. Retained earnings is increased by net income of the period. This is essentially how the balance sheet and the income statement link. It decreases with dividend payment, but we will come back to that when we build equity financing and dividend payout schedule. That's it for this video. We covered a lot and saw how each and every engines are constructed in the spreadsheet. In the upcoming videos covering how to model each schedule, we keep coming back to these engines. So don't worry if you are overwhelmed. As we see how each of the schedule link to the engine and produce outputs, it will start to make sense.